All right, everybody, welcome to the All-in-One Loan Lunch and Learn presentation this afternoon. I'm glad to have you all on the call. So let's go ahead and get started. We've got lots to review. For introductory purposes, my name is Erin Wood. I was actually part of the team that helped launch this product back in 2005. So I have a unique experience and perspective level on this loan to offer myself up as a subject matter expert to the loan officers that you're working with. Speaking of which, you are working with Steve Kellerman, and he has lots of experience in the industry. In fact, he is a great advocate of our all-in-one loan and knows all of the ins and outs and will be able to properly assist you with any questions you have after today's call. Now, before we get too deep into the all-in-one loan, I do want to set the stage a little bit and give a little bit of context as to why we've brought the all-in-one to market. First and foremost, the U.S. is in $11 trillion worth of mortgage debt, and that's comprised of over 48 million households in the U.S. that owe a mortgage on their homes. So we're in good company. There's definitely a lot of us that are out there. But what I do find odd is when you contrast that against the student loan debt at 1.5 trillion, that's mentioned as being a national crisis. I find it odd that there's nobody talking about the $11 trillion worth of mortgage debt and how we as consumers can get out from underneath it. Now, most notably, the reason behind that is because the banking system has been using the amortization schedule since 1938, and it hasn't been innovated since. And that's because it's a reliably profitable way for the banks to continue to make money. So there's been no need for them to innovate it as far as they're concerned. Now, that's where the all-in-one loan comes in, because mortgage amortization, actually, if you were to Google that or go online and look at the definition, in black and white, it'll tell you. I mean, you don't have to take my word for it. It'll say that it's a repayment method where the bulk of the payment goes towards interest first, and then whatever's left over goes towards the principal balance reduction. Well, as the loan matures, more of that's going to go towards the principal balance, but unfortunately for us, that 50-50 point doesn't happen until around year 22, 23 of the loan. Now, this mortgage amortization schedule has allowed us as consumers to believe in one huge myth, and we believe in it wholeheartedly. And that is, if we have a low interest rate and we have a low monthly payment, then gosh darn it, we must be getting a great deal, right? No, it's a great for the banks, but not for us consumers, especially when you factor in our behavior as consumers, which every 5 to 7 years, we're refinancing or recycling our debt. Now, if you take a look at the screen, every column represents a year. Go ahead and count back 5 to 7 columns. How much in interest are you actually paying versus having principal balance reduced? This is why we say that low interest rates do not come with low interest cost. Because when you factor in our behavior as consumers, every time that we refinance, we're just restarting the clock on this amortization schedules. And the bank is glad that we're doing it. They have no need to revamp the amortization schedule. They're making a killing on the interest costs that they're recouping from our mortgages. Now, the kicker, this is a closed-ended instrument. So if you decided you wanted to get ahead and prepay your mortgage at all, the bank's not going to give you that back if you need it, which is why, statistically speaking, as consumers, we typically do not prepay on our mortgages because we do not want to part with money that we can't get back if we need to. Now, if you take a look at the impact that the amortization schedule actually has on our wealth building with real estate, it actually eliminates the financial benefit that we're able to achieve with owning a home. And I say that because if we look at an example of a purchase of a $450,000 home, I'm going to ultimately end up paying over $600,000 for that when you factor in all of the interest and assuming that I didn't refinance somewhere along the way. Now, for this example, let's just say I'm going to come in with $50,000 of my own money. That's going to be my investment into this property. If I got a 30-year fixed rate mortgage at 3.5%, by today's standards, that's a good deal. But the amount of interest costs that I would have to repay on that, assuming I didn't refinance, is going to be over half the amount that I borrowed. And when you break that down into the interest cost per tens of dollars, I have to pay back $6.17 for every $10 I borrowed. Well, why am I breaking it down into the tens of dollars? Because as consumers, we have a hard time relating to the interest costs that we have to repay because we can't relate to hundreds of thousands of dollars. We haven't held hundreds of thousands of dollars in our hands before. And so at that point, we might as well be talking about millions of dollars, right? So I like to break it down to something that I can relate to so that I can fully scope how much in interest I'm actually paying, putting it into terms that make sense to me. And I do that by breaking it down to the tens of dollars. So in this case, for every $10 I spent, I paid back $6.17 in interest. That's going to ultimately increase my purchase price by 45%. And that's all with the 3.5% fixed interest rate. This is by today's standards a braggable interest rate. I'm sure if you had 3.5%, everybody in your circle would know that you had it that low because that's something we would brag about. We would equate that with getting a good deal. And you could absolutely argue that my home's going to appreciate, and it will. And if we use a 3% appreciation factor, my home is going to be worth over $1 million. So I'm happy about that. That's good. That's a good growth for the investment. But when I factor in the interest cost that I had to pay on that perceived low interest rate, that actually took away 23% of my cumulative wealth. Not that great of a deal, actually, when you break it down like that. And when you consider the piece of the pie that we have each month to put towards not only our living expenses, but also to pay ourselves for retirement or savings, we put more towards our mortgage than we do towards our own retirement. And America as a whole is vastly underfunded for retirement. But how can we save more? We could absolutely make changes to our car insurance or our cell phone provider, or maybe cut out cable. But those changes aren't going to allow you to retire. It's not going to send your kids to college. Those are just some slight changes that we can make. Now, the area of mortgage interest costs is one area that hasn't been touched yet. And it's an area we think that we can improve in, and it's been proven and shown that we've helped borrowers save exponentially on interest costs by using their money to their benefit. And that's where the all-in-one loan comes in. And for homeowners and homebuyers alike, there are some things you get to take advantage of with the all-in-one loan that traditional financing was never intended for you to take advantage of. First and foremost, you get to have a principal reduction faster, 2 to 4 times faster on average than you would in a traditional mortgage. You have a reduction of interest payments month over month. You are able to reach in and access those available equity dollars at your discretion, and all of that happens without you changing your spending habits, your budget, or your lifestyle. We really do want to make this as easy as possible for you to be as successful as possible in not only paying off your mortgage, but saving exponentially in interest cost. Now, let's get into the background of the product because I do hear often, well, Erin, if this product is so great, how come I've never heard about it? And we launched this in 2005. I was there, it happened. And in 2005, it was definitely a different environment. We had a lot of industry professionals that were encouraging borrowers to leverage their equity, to do a cash out refinance. There were even some that were encouraging borrowers to not pay off their mortgage, that it was a better sound decision to have their mortgage intact than it was to have it paid off. Now, the messaging for the all-in-one was a little counterproductive to that, but the clients that got into it in 2005, 2006, 2007, and the beginning of 2008 were better equipped to handle what happened in 2008 and 2009 with the secondary market crash. Those clients were less likely to be underwater on their homes. Fast forward to present day, and we've helped tens of thousands of borrowers utilize this loan to help them save money in interest costs and time on even paying a mortgage in the first place. Now, the thing that I am most proud about with this product, the thing that I still am passionate about to this day, is that since 2005, we haven't had a single loss, foreclosure, default, or delinquency. Now, I'm not sure if you understand the weight of that statement, but that's a pretty heavily weighted statement because that's something that Freddie Mac, Fannie Mae, FHA, VA, USDA, they couldn't say that same sort of thing. And they couldn't because America as a whole actually has the highest default rates of any other country out there that offers home financing. But when it comes to the all-in-one, we haven't experienced a single one, which is a huge testament to what happens when you give borrowers more control over their money versus the banks taking advantage of it, and when you give them a mechanism to allow them to save money in interest costs. Now, what makes this product so different? Why do we stand apart from any other product that's out there? And it's because it's an offset mortgage or a type of offset mortgage. In fact, this is an offset mortgage with line of credit characteristics, and we'll get into that today. And if you're unfamiliar with what an offset mortgage is, that's completely all right. Again, we're going to go over that so that you can understand the benefits and decide whether or not this is going to be something that's going to be beneficial for you. Now, the offset mortgage in and of itself is home financing and personal banking combined, which may sound completely strange and out of left field, but I promise I'm not a crazy lady. This actually makes a lot of sense when you think about it. But first, let's talk about where offset mortgages came from, because rest assured, this is not something that we just thought up overnight and decided to bring to market. The exact opposite is true. Other countries have been using offset mortgages for decades, most notably Western Europe, Canada, Australia, and New Zealand. Our story actually begins in 2002 in Australia, but I'll save that for another day. But even though these other countries have developed and innovated the offset mortgage, that doesn't mean that it's brand new to the US, not by any means. We use offset mortgages in the commercial lending space, we just happen to call them by different names. We call them sweep accounts, ZBAs or zero balance accounts, or universal accounts. But the functionality still exists. However, unless you've purchased or financed a commercial property, chances are likely that you have not heard about this product. Now, there are some differences between how the US handles mortgages versus these other countries, and I'll go over a few of them with you this morning. First and foremost, these countries do not have a robust secondary market like we do here in the US. They have one, it's just not robust like ours is. If you've ever purchased or refinanced a property and maybe 8 months to a year later, your servicer changes, that means that your mortgage was bought and sold on the secondary market. Now, another difference, these countries do not allow their homeowners to write off the interest they pay on their home loans on their mortgage or on their taxes. So again, as a way to innovate those industries in those countries and maintain a longer relationship with their homeowners, they developed and came up with the offset mortgage. Now, you might be asking yourself, okay, well, I'm glad I know all of that, but how does an offset mortgage work? And that's what we're going to go over right now. Now, this piece of the presentation might seem like overkill for some, but I like to fully equip everybody that I'm talking to about this product. And I like to assume that everyone's going to do their due diligence and their research before they decide to get into the loan, which means you're going to more than likely Google or go online and type in what is an offset mortgage or how does an offset mortgage work. And the likelihood of you pulling up articles from other countries is very high. I know this because I've done it. I've read them. And I want you to be able to differentiate between how these other countries do their offset mortgages and how we've done the all-in-one. Now, if I was to go to Canada and get an offset mortgage, this is what it would look like. I would have my mortgage and I would have a cash account of some sort. Now, this cash account's typically stagnant, meaning you can't really use it. There are certain amounts that you have to maintain on deposit to even qualify for the offset feature. Not only that, but you're not really going to earn very much of any in interest on that account. They're not interest-bearing accounts. But the advantage you do get is they will use what you have on deposit in your cash account to offset the amount they calculate interest on in your mortgage. So in this case, for the $400,000 example, if I had $100,000 in my cash account, my interest costs are going to be calculated at $300,000 versus $400,000. So this is going to be a good deal. This borrower is absolutely going to save some time and money on their mortgage. But the adverse things you still have to consider is that it's not an interest-bearing account, and they can't use it because they don't want to dip beneath that threshold, and there's still an amortization schedule attached to the mortgage, so they're not getting out of it that easy. Now, in the all-in-one, we've changed things up slightly. But before I get into that too deep, I want to make sure everyone on the call understands this one thing because it's pretty important that you do. Here in the US, the banking system purposely keeps your checking account separate from your mortgage. And they do that on purpose because it's to their benefit that they can keep your money separate. Now, in the all-in-one, we've removed that invisible line and we say, go ahead and let your checking account talk to your mortgage. And that might sound, again, like I'm a completely crazy lady, but I'm not, I promise. This actually makes a lot of sense when you start to think about it. So let's walk through this. When we get paid every other week or every month, what do we do with our paychecks? Because we're not putting them under our mattresses. We put them in our checking accounts, right? And what's the reason we do that? Because checking accounts are safe they're secure, and they're easily accessible. Any other reason you would use a checking account, and it's going to fall into one of those three categories. Now, in the all-in-one, your money stays safe, it stays secure, and it is 100% completely accessible using the methods you're used to using today. Only now you get to put your money to work for you versus having it sit at the bank where they get to take advantage of it. Now, in the all-in-one, you get an ATM card that's backed by the star logo, so you can use it as a point of sale or at the ATM. You can order personal checks. You can set up online bill pay. There's even a mobile banking app where you can take a picture of your check and deposit it into your all-in-one account directly from your phone. You can ACH wire transfer. You can add additional users to the account. There's fraud protection features. All of the bells and whistles that you're used to seeing in your checking account today will be present in this loan. Now, how it works, every time you make a deposit into the all-in-one account, what happens is at 12 a.m., that deposit is going to sweep into the mortgage side of the account, reducing the balance by the amount of the deposit. Makes sense, right? Well, you're probably thinking to yourself, okay, well, Erin, yeah, it makes sense, but I have to use that money. I've got groceries to buy, extracurricular activities for the kids. I need to spend that money. And you know what? We agree with you. In fact, we don't want you to change your spending habits, budget, or lifestyle. Whatever you're doing with your money today, do tomorrow in the all-in-one. So inevitably, when you spend money out of the account, the balance is going to go back up by the amount that you withdrew. Still makes sense, right? The beautiful thing about this product, though, is while that money is waiting to be spent, that's sitting in your account, keeping your balance low, which is in turn going to keep your interest costs low. And I say that because the way that we calculate interest is different than any other product that's out there today. We're going to take a daily calculation of the interest cost based on that unpaid principal balance. We're going to use the LIBOR index plus the margin that you choose with your loan officer. Then we're going to times the unpaid principal balance by that interest rate. Then we're going to divide it by 365. That's how we get to the daily interest cost based on that balance. Then at the end of the month, we're going to tally up those daily interest calculations, and that's going to become the interest-only portion that's automatically drafted out of the account the following month. So yes, you heard me right. You pay principal first all month long. We settle up on interest the following month. We're calculating interest simply. You are paying it in arrears. This is the only loan in America today, guys, that will allow you to do this. And we never change how we calculate interest. It's always going to be calculated based on that day's unpaid principal balance, added up at the end of the month, and deducted automatically the next month. Now, there are 4 ways that you can save in this loan that you can't save in a traditional checking account and mortgage setup. First and foremost, every single deposit that you make into this account reduces the principal balance. So deposit equals principal balance reduction. Even the money you're going to spend, which is number 2, the money that you're going to spend anyway, is going to save you money until you spend it. Now, I would invite you to ask yourself these 3 questions. Do you buy all of the food that you need for the month in one day? How about gas? Do you buy all the gas you need for the month in one day? And then what about your bills? Are all your bills due on the same day? Chances are you said no to all 3 of those questions. You're periodically spending money out of your account as you need to spend it. And in the all-in-one, until you spend that money, that's going to keep your balance low, which is in turn going to keep your interest costs low. Now, the 3rd way you save money is by not changing your budget, your lifestyle, or your spending habits. And that includes the previous mortgage payment that you were making. Now, in a $400,000 30-year fixed-rate mortgage at 3.5%, your principal and interest payment each month is going to be $1,796. These borrowers are continuing as if they have a $1,796 mortgage payment to make. But writing, sending that to the bank, having the bank take a huge portion in interest and only apply a little bit to the principal balance, they get to keep that $1,796 against the principal balance all month long. We used to say in 2005 that keep your current mortgage payment with this product, which is our way of conveying to them not to change their spending habits. So continue budget for the mortgage payment you have to make, and it's going to save you money. Now, the 4th way that you save is your leftover cash, the money that you didn't necessarily need to spend in the first place. Sure, that's sitting in there in the form of home equity dollars, but it's completely accessible for you to use if in the event you need to use it. It's just until you do, You're putting it to work for you, keeping the balance low, which keeps interest costs low. Now, it's been my experience over the years that there are 5 reasons I continually see borrowers getting into this loan. First and foremost is the ability to save an interest cost. Everybody is consumer minded if you think about it. Whenever we spend money, we want to get the most value for the money that we're spending. That's evident in how we shop. If we were to go to the store to purchase an item and after taxes and overhead, it seemed like the cost was inflated, we usually walk away from that and we go home and order it on Amazon or at the store down the street. So again, we're constantly looking for the best value for the money we spend. Yet when it comes to our mortgages, we're so caught up in that myth of low interest rate equaling low payment must mean I'm getting a good deal. We're not seeing the amount of interest costs we're actually paying the bank when we factor in our behavior as consumers. So saving money and interest costs first and foremost is something everybody can agree is a good idea. Number 2 and number 3, just in my personal opinion, I believe they go hand in hand. And I say that because if you're a borrower that doesn't believe in paying off your mortgage, that's okay. There's still plenty of borrowers out there that believe in that same school of thought. But I'd almost venture to guess that means you're leveraging your equity to go build wealth in other areas. And in the all-in-one, you're going to have access to those available equity dollars 2 to 4 times faster than you would in a traditional loan. And you get to save money while you're doing it. Now, what happens when we're building equity? Yep, we're reducing our principal balance. We're reducing our credit risk. So if you're a borrower that is motivated to be mortgage-free or debt-free as soon as possible, this loan's going to get you there, and it'll get you there 2 to 4 times faster without you having to change your budget, lifestyle, or spending habits. Now, number 4, this is really where I think the misconception that this is a HELOC or a HELOC alternative comes in. Keep in mind, this is not a HELOC. This is an offset mortgage with line of credit characteristics. Those characteristics begin and end with the fact that it's a two-way instrument, meaning money can come in and money can go out. That's it. It ends. Traditional HELOC products typically have a draw period of 5 to 10 years. And then after that, what are we presented with? Yep, balloon payments and re-amortized repayment schedules. Well, as consumers, what is our behavior when we're presented with those options? Yep, you're right again. We refinance, which ultimately changes the trajectory of our financial goals, and we end up paying more in interest on the same debt. So those features don't help us out the way that we would want them to as consumers, and we don't have to worry about them because they're not present in the all-in-one. Yet you still get the ability to reach in and utilize equity dollars to your advantage and at your discretion if and when you choose. Now, I'm of the school of thought that removing emotion from big decisions that I make is a good idea. I try to do that every time. But there is an emotional decision in the all-in-one that you have to factor in, and that is it becomes an unintentional safety net. What do I mean by that? The all-in-one is a mechanism that allows a lot more grace and flexibility to borrowers if in the event life happens. And I say that because if you don't make a deposit for a month or 2 or 3, or in some cases years, you don't have to worry about going into default or losing the home. As long as there is available equity dollars there to absorb any interest costs that become due, you don't have to make a deposit. We get emails and letters all the time for borrowers in this loan thanking us for making it available because we helped them through some ebbs and flows of life that they would have not been able to make it through if they had a traditional mortgage and checking account set up. So again, the flexibility that's offered with the all-in-one is unlike any other product that's out there. Now, getting into the account servicing piece, we partner with Merchants Bank of Indiana and North Point Bank. They take excellent care of our clients. In fact, there's a dedicated customer service line that you can call in if you have questions post-closing. Now, speaking of closing, the closing piece is a little bit different than you might be used to. In a traditional loan, we pre-fund the interest costs at the closing table. Well, there's no pre-funded interest or prepaid interest in the all-in-one. We want you to get started right away utilizing this account. So within 3 to 4 weeks from closing, you'll receive your info packet. That's going to include your Visa card, forms to order checks. You can set up direct deposit, get your bill pay all squared away. So within 3 to 4 weeks, you'll have your information and you'll be able to start utilizing your account to your advantage. Now, I've said on the call that this is an offset mortgage with line of credit characteristics. So what do those characteristics look like? Well, first and foremost, we know we don't have to deal with a balloon payment or a forward amortizing repayment schedule. So we already don't have to worry about that. But what you will notice is after 10 years, the credit limit you're approved at starts to decrease slightly by 1/240, or the remaining 20 years, however you want to mathematically work that out in your mind. Now, a question I get asked often is, okay, well, Erin, does that mean after year 10 I have to make an additional deposit? And my answer is always the same, no, not at all. In fact, on average, our all-in-one clients are paying off anywhere between 8 to 12 years. We have some extreme cases where they pay off in 2 to 3, and we have some other cases where they've been in the loan since 2005. They're coming up on their 15-year anniversary, and they're already in their credit limit reduction phase, but they continue to stay in the account because they like to have that flexibility and optionality. Now, up on the screen is a perfect example of how an average borrower has utilized the loan. They get into it and they don't change budget, lifestyle, or spending habits, but they're automatically seeing a reduction in principal balance. They're able to take some money out along the way, and then once they reach the $0 amount, they can either close out the account and be mortgage free. Congratulations, you paid off your home. Or you can pay the $60 annual fee that's waived the first year and continue to have access to the account to use at your discretion as you choose. So this is really just a great flexible way that the all-in-one can be as individualistic as the family or household that has it. And this is some flexibility that a 30-year fixed rate mortgage would never be able to afford you. Now, getting into the topic of interest rates, and I say this is a hot topic because anytime we start a discussion with an industry professional about mortgages and financing, what are the two first questions we ask? What's my rate and what's my payment, right? We know why we ask those questions. But in the all-in-one, you've got 3 rate term options you can choose from. We've got the 1-month adjustable, the 3-year fixed, and the 5-year fixed. Now, we know some things about the LIBOR index, which is what's used on this product, that makes the 1-month adjustable a little bit more appealing than the 3-year and the 5-year fixed. And I'll share those items with you. First and foremost, the LIBOR index tends to be the index that banks use to lend between themselves. And the banks are always looking out for their best interest. So if it's good enough for the banks to use, it's good enough for us to use. We also know that LIBOR follows the Fed funds rate a lot closer than the regular mortgage products that follow the bond market or mortgage-backed securities. So they act and react differently to market conditions. Over the last 25 years, LIBOR has had 4 increasing rate cycles that have lasted about 30 months on average. And there's been 4 decreasing rate cycles that have lasted about 35 months on average. So we know LIBOR spends more time coming down than it does going up. Not only that, but LIBOR tends to be a stable index, and I get it, it's an oxymoron to call any index stable, but LIBOR does tend to be one of the most stable indexes out there. And when it adjusts in the hundredths of points, not in full points. Now, although the 3-year and the 5-year fix will protect you from it going up, you don't get to take advantage of it coming down. Now, we do have some margin options that range from 2.5 to 3 3/4, and there are different options for the fixed terms than there is for the 1 month. They have a little bit more of a restricted margin option. And because it's an adjustable, we're not going to let it adjust indefinitely. We have a 6% life cap attached to this, and that's going to be 6% above your fully indexed rate, which is index plus margin. And we also have a floor of 0.75, so the lowest rate you would ever pay would be 3.75%. Now let's get into an example because as they say, it is just math, it's not magic. I'm going to use the $100,000 example, the 30-year fixed rate mortgage against the all-in-one, which is open-ended with a higher interest rate. I'm going to use a borrower and a co-borrower with salary and expenses, which leave them with about 13 to 14% in positive cash flow at the end of each month. Now, in the example, they make their deposit into the account, and at 12 a.m., that sweeps to the mortgage side of the account, reducing the balance by the amount of the deposit. Now, that money still stays 100% liquid to be used however you normally use it. It's just until you use it, it's going to keep that balance low. But my borrowers are spending money out of the account throughout the month like they normally do. They didn't change anything with their spending habits. We end month 1 with a lower balance than started with, and they're already starting to accrue leftover equity dollars, which is their previous mortgage payment and their positive cash flow. Well, we get to month 2 and the deposit goes in again, which makes the balance go down, and then spending makes it go back up. Well, now their expenses are including the interest payment that was calculated from month 1. That's being drafted in month 2. And the interest that we calculated was $14.73. Now we are going to end month 2 with a lower balance than we started with again, and we're still accruing available equity dollars. Well, we get to month 3, and again, the deposit goes in, which makes the balance go down, and spending's going to make it go back up. Now take a look at the interest payment for month 2. It's $14.65. For month 1, it was $14.73. What's the main reason that we as consumers continually chase interest rates and refinance? Because we want a lower payment. We equate that with getting a good deal. And then the all-in-one, without changing spending habits, budget, or lifestyle, you can see that these borrowers had a reduction in interest costs from month 1 to month 2. Now, if we were to take a snapshot of this borrower just after 3 months or 90 days in the all-in-one versus their counterparts in the conventional mortgage, they have a better equity position of over $6,800. And you could absolutely argue that the longer you're in the loan, the more you're going to save. That's just math. Now, when it's all said and done, though, years to pay off, 30 years versus 12.6 years. I mean, that sounds good, but it doesn't really resonate, does it? And that's because we don't think of our money in terms of years. We think about it in terms of months. So if these borrowers were sitting in front of me, I would position it this way. Would you prefer 360 payments of $1,796 or 148 payments of about $1,100 on average? It'll be higher at the beginning, as you saw in the demonstration, but it's also going to be a lot lower towards the end. So as a consumer, always looking for the best deal and looking for the best value for the money you spend, what sounds like the better deal? 360 payments of $1,796 or 148 payments of about $1,100 on average. And when you take a look at the total amount that was paid back in the conventional loan, I paid back over $600,000. My interest as a percentage of principal was 62%. So if I break that down to the tens of dollars, for every $10 I spent or every $10 I borrowed, I had to pay back $6.20. So borrow 10, pay back 16.20. And the all-in-one, I paid back over $500,000, but my interest as a percentage of principal was only 31%. Break that down into the tens of dollars, and for every $10 I borrowed, I had to pay back $3.10. How does that happen? Because it's not about interest rate, guys. It's about the size of the debt the interest is calculated on. Remember, this is an offset more, so putting your money to work for you, keeping the balance low, that interest costs are calculated off of, but your money is staying liquid for you to be used if in the event you need to use it. Now, this 30-year fixed rate mortgage at 3.5% would actually need to be locked in at 1.912% to achieve the same type of interest cost savings that my borrowers were able to achieve in the all-in-one. And when you take a look at the savings or the wealth accumulation difference, again, depending on how you want to look at it, my borrowers in the all-in-one saved over $120,000. I don't think that's chump change, not by any stretch of the imagination. You could probably ask every homeowner today if they thought $120,000 was chump change, and I would venture to guess almost all of them would say no. Because that's kids going to college, that's helping our parents as they get older, that's building our property portfolio or investing in our own retirement, or heck, just doing something better for the family and the household than paying that to the bank in interest cost. And then when you boil it down to the difference between a traditional loan and the all-in-one and how payments are applied, it really does boil down to this. In a traditional mortgage, you have an amortization schedule that you're bound to. The bank, in advance of the loan closing, knows exactly how much that payment's going to be, which is good for them because then they know how much they're going to take for interest and how much they're going to allow you to apply to the principal balance. In the all-in-one, we take a different approach. We say go ahead and utilize the largest asset you're likely going to have in life, which is the income dollars you earn. Put that towards the largest debt you likely have, which is your mortgage. Save money in interest costs, pay off sooner, and have accessibility to those equity dollars without necessarily having to refinance. So it's like a win-win-win for the borrowers. Now, who is this right for? The question or the answer I say is going to change depending on who you ask. If you ask me, I think every single American needs to know they have this option available. But does that mean I think it's right for every American? Oh, heck no. Not at all. If money burns a hole in your pocket or you're not a good steward of your money, this is not the loan for you. There are plenty of other loan options out there, but this isn't one that I'd offer. However, if you are a good steward of your money, if you live within your means and don't spend more than you earn, and if you've qualified for a mortgage in the past, chances are you're going to qualify for this one. And at the very least, you'll save money in interest costs and possibly time on paying your mortgage. People who are self-employed or are entrepreneurs or have fluctuating income absolutely love this product because it offers them a lot more optionality and flexibility than a traditional mortgage does. People who are considering retiring or are already retired, small families down the street that just live within their means, they all can benefit from a product like this, if at the very least it being interest savings and time on paying a mortgage. Now, once you've decided that this might be something you want to explore a little bit further, this is where the simulator comes in. And this is something that Steve can help you walk through. There are some defaults that are put in, but this is completely interactive, meaning you want to make sure you're putting in accurate data so that we can return correct results. As I like to say, good data in equals good data out. Bad data in equals bad data out. And Steve will be able to go through and walk you through each stage, explain the product to you, answer any questions you might have. And then when you get to the results page, you can toggle back and forth between different rate term options and margin options. So this is really an excellent tool to decide if this is going to be something that works for you or not. Now, your next steps. If this is something that you're interested in, if anything in this presentation appealed to you and you want to discuss it further, I would highly advise reaching out to Steve Kellerman. I've worked with him over the last year or so, and he is excellent in understanding the product. He's very passionate about it, and he is an excellent resource for you to lean on with any questions that you might have. So at this time, I'm going to end the presentation. I do hope that it was helpful for you and that you learned something. And if there's ever anything that we can do to help you in your journey into the all-in-one, please don't hesitate to reach out. We're here to help you however we can. So again, I do want to thank you for your time and your attention, and I hope you all have a wonderful day.